Well, hello everyone, and welcome to this joint presentation today. We have two independent companies under one roof in Leveraged and CMC Markets. And today, Julie McKay and I will be looking at successful gearing strategies. Now, a little bit of housekeeping before we start. On the control panel that you'll see on your screen, there are two windows marked questions and chat. We're not going to use the chat window today, but we will use the questions window. And as we go through today's presentation, if anything comes up that you'd like more information about or you're not sure about, please feel free to type a question into that questions window, and we'll leave 10 minutes or so at the end of the presentation to talk to those queries and comments from you, the attendees. There's lots to talk about today. This combination of investment tools can result in very powerful investment returns, and we'll look at some of the ways that can occur. But before we do that, there's some important information that we must look at. And on the screen in front of you, you can see some very important information. And if you'd like to have a look through that, there are a couple of things I'd like to highlight while you're having a read. First of all, as individuals, as investors, we come to the market with different backgrounds, different levels of experience, different goals, different timeframes, different amounts of capital, and all of these things mean that investment decisions are very much a personal matter. Today's presentation, of course, because we don't know you directly, is not prepared with your personal circumstances in mind. Today is a general information session only, and the decision as to whether or not any of this information is useful or applicable in your circumstances is one entirely for you. Now, you'll see on the screen that there are product disclosure statements from both CMC and Leveraged. In that second last paragraph, there are some contact details. You can get in touch with either organisation to access those important documents. And it's important that you understand the risks and potential rewards of using these sorts of tools, and the PDS is a very good source of that information. There's also information available from both our websites at Leverage and at CMC, and you can call our teams with using the 1300 numbers. You can also see on your screen if you have any further questions, in particular about the potential risks associated with using these products. Now, if after having checked out those sources of information, you're still not sure about any aspect of this, please seek independent advice. Okay, with that important information in mind, let's turn to an outline of today's session. It'll be a joint presentation between myself and Julie McKay. We've been discussing how to correctly pronounce our names. And today we'll be looking at four main areas of interest in combining share investment and leveraging. So we'll look at gearing for success, why people used leverage investment vehicles. Now, if you own a home and have a mortgage on it, you're already familiar with the power of leveraging. And today's session is aimed at transferring or looking at how you can use that power of leverage in the share market. We'll have a look at how bringing together CMC and Leverage has resulted in a single offering in one place, offering you the ability to oversee, to manage, and to change your investment profile all in the one place on the CMC platform. A very important aspect of today's presentation are the risk management strategies that we'll be discussing. And both Julie and I will look at them, one from a leveraging point of view and two from a market point of view, to make sure that you have all the tools available at your fingertips. We'll then look at some more advanced gearing strategies to round out the session, and in particular, using options for investment purposes and how that can be combined with leverage to increase the power of your investments. So with those four areas in mind, I'm going to step back for a moment and hand over to Julie, who's going to have a look at gearing for success. Thanks, Julie.
Thanks, Michael. So we're going to run through this fairly quickly. I think what I want to say to begin with is that as Michael had said, we don't know about your goals or whatever, and there are a variety of different financial goals. Everybody has a different goal, what they're trying to achieve, whether it be a comfortable retirement, whether it be educating children, whether it's just having a nice safety buffer, everything. It's a finite number of goals. The thing about those financial goals, though, there's only a finite way to achieve those goals. And what I mean by that is you've only got 4 levers that you can pull to achieve a financial goal. You can, for example, delay the goal. You can retire later, for example. You can increase the amount you save. You can change the goal. So you can make it slightly lower, you can make it slightly higher. All of those things are fairly useful. Some things you can't change. For example, you can't delay educating the children until they're 13. There are certain goals, certain factors there that you just can't change. So really, for a lot of people, what it comes down to when it looks at achieving their financial goals, it's around the rate of return they want to get. And this is all about asset allocation. So it's about, maybe shifting out of, cash in terms of those safer assets into more riskier assets with the expectation that you'll earn a bigger return. And this is where gearing comes in. It's about boosting that potential rate of return, okay? So that's what we're focusing on, is this rate of return idea as a way to achieve financial goals. And again, I always link back to financial goals. So that's ultimately what you're going to have to do, is try and achieve something. So you don't just do these strategies for the heck of it or for the fun of it. Maybe you do, but most people don't. You really are trying to achieve a goal. So what are the sorts of goals that we're talking about here, and why do I think that you maybe have to boost your returns a bit more than just, having a bit of equity and a bit of cash and all this sort of stuff, right? There's a couple of things, even with people like yourselves who are prepared to invest in equity markets, take a bit of risk to earn potentially a higher return. There's still potentially fairly large gaps between your goals and your savings and investment plans. And a couple of these sort of big headwinds that I think are coming against us are the actual numbers that people need for their retirement. And again, I don't know your personal circumstances. I don't know, can't sort of say what numbers you might actually need. But when people are sitting there saying that, at least half of us are not confident about our ability to maintain a comfortable retirement, that's quite a telling sort of number. And I don't think that really just comes down from people, just sort of a vague nervousness or whatever. I think they've actually looked at the numbers and thought, I'm actually going to need a lot more here than I actually anticipate. I think also what a lot of people forget and maybe ignore is inflation. Now, we all know inflation at the moment, headline inflation is fairly benign. RBA sort of didn't move rates yesterday simply because inflation has been kept in a box. But unfortunately, in a lot of our key goals, things like education, health and housing, inflation is running at much higher rates. On average, it's around 2% above your headline CPI that the Reserve Bank manages to. And in some cases, in some periods, it's actually more like 4 or 5%. That's a fairly strong headwind to get across. You've got to earn at least, let's call it about 5% after tax simply to stand still. That's a fairly significant return you've got to do just to stand still, not even to get ahead. And when you look at Australian equity markets, and again, look, there are a lot of professionals in this world, people who know how to invest in the markets, but on average, after fees but before taxes, you're looking at about 9-10% on average, right? Doesn't mean that people don't do better than that. Certainly there are better years than that. Sometimes there are worse years. So we're talking about sort of long run average. So if we're talking about inflation about 4 or 5%, and then you're earning returns about 10%, all of a sudden the gap between your goals and your plans starts to look a little bit wider than perhaps you'd want to be comfortable with. So, and again, linking those two ideas of goals and the way you plan, and how then are you going to go about boosting the returns that you potentially might use. And this is where gearing comes in. It's all about looking at the return. So again, I always start from the idea of goals and circumstances. We never want to say, it's never just doing it for the sake of doing it. It's always aligned to a particular financial goal that you're trying to achieve. You have to have a view of the market. Certainly, if you don't think the market's going up, you don't gear. And certainly, probably, if you think the market's going down, you probably don't invest at all. But you have to have a view of the market. You have to think that the returns that you are going to earn at least exceed the cost of gearing. which is basically the interest rates and fees and taxes and all that sort of stuff, which we'll talk about in a moment. But essentially, those are what you've got to think about. And where all this boils down to is you've got to decide on not sort of the dollar amount you have to borrow. So when you think about a home loan, for example, if you ever typed into one of those bank calculators, you plug in how much you can earn and what the interest rate is, and it pops out a number that says you can afford to borrow, $400,000 or whatever the number is. When you're looking at gearing into equity markets, it's all about the gearing ratio. What is the proportion of the amount that I've borrowed versus my own personal capital amount? I'm certainly not saying that the dollar amount that you borrow isn't important. It is, because prudent investors never borrow more than they can afford in repayments. And I'll go into that a little bit more when we talk about the risk management strategies. But essentially what comes down to when you talk about gearing is, what's my goal? What is the expected return that I need to achieve that goal? How am I doing that in an asset allocation? So what am I investing in, equities and all the different things? And then therefore, what is the ratio that I need to borrow to achieve those sorts of returns, and what are my views on the market? So it all comes together into a gearing ratio. And again, just to be clear, I'm always very determined to make a distinction between what I call the gearing ratio and what everybody might be aware of as the LVR, or loan to value ratio. Often you see that language bandied around LVR. Every loan has an LVR. Even a home loan has an LVR, because typically a bank will lend 80% against the value of a home. That's the loan to value ratio. It's simply the maximum amount the bank will lend against a particular investment as expressed as a percentage of that investment. So 80% of the value of the house you can afford to borrow. Gearing ratio is where you are looking at the actual amount you borrow. So, for example, Leveraged might lend 75% against BHP shares, just by way of example. But because of your goals and circumstances and your view on that particular stock, you decide only to borrow half of the amount you intend to invest. In that case, your gearing ratio is 50%. So, your gearing ratio could be whatever it is that leads to your particular circumstances and outcomes, which is different to the LVR, the maximum amount the bank will lend. And the reason I try to make this very clear distinction, because it makes it a little bit easier to understand when a margin call might occur. Because a margin call occurs when your gearing ratio exceeds the maximum amount the bank will lend. So again, it's this idea of, if your portfolio starts to fall in value, your gearing ratio goes up, starts to approach the loan to value ratio, or the LVR, and you're starting to hit sort of red flags, okay? So again, we're going to talk about a little bit more about that when it comes to the risk management strategies. So for the time being, I think what I wanted to do then also is just look at this idea of the gearing ratio and compare it, and look at again to this idea of achieving particular goals. So, you don't just simply use a rule of thumb. You don't just simply say, I'll just gear to the maximum that the bank allows. 75% against BHP, that's what I'll borrow. That might be appropriate to your circumstances and strategy, but it may not be. It may be that achieving your goal, and this is just a very simple graph showing, okay, if you had started with 50,000 of capital, if you borrowed, certain amounts, different ratios, say 50%, which is that middle line there, you after 5 years, given the assumptions that I've used here, could achieve, let's call it about 90,000, so you've almost doubled your money in that particular scenario because of the way I've set up the constant returns and so forth. So if that is your goal to achieve, in this example, 89,000 after 5 years, then 50% gearing is the appropriate level. But, again, it does depend on your view of the market. And if your goal is higher than that, then possibly a higher gearing strategy is the way to go. So really the message that I want to get across to people is this idea is the decision, first and foremost, is what are my goals? What do I think the market is going to do relative to interest rates? And what returns do I need to achieve my goals in that market? And that determines the sort of gearing ratio that you need to do. It's a very different decision to what you might look at other lending, for example, home loans, where you look at dollar amounts, okay? So on that note, I think at that point I'm going to hand back to Michael, who's going to run through the next topic of our one offering.
Thanks, Julie. And that is one of the most important aspects of today's webinar, in that if, like me, you have investments across asset classes, you have relationships with a number of banks, and you have possibly at least one accountant to help you out with all of that, the idea behind bringing together the back ends of Leveraged and CMC is to provide you with a convenient and easy way, not only to transact, but also to track your exposures and adapt them as necessary to market conditions. And for that reason, within the CMC platform, you can see that a tab has been created called Margin Loans. And you can access that via the tab, which you can see on your screen in this pink circle, or via the account tab at the top. But whichever way you go, you'll be able to find margin loans integrated with all the other offerings on our site. And at CMC, we see the partnership with Leverage as a very important part of the broadening of the offering available on the CMC platform that recently has added instruments like M funds and will soon be adding corporate bonds. It's about putting all of your investment needs and tracking needs on one platform. And when you click on that tab and go to the margin loan offering, this is the sort of list you could see. Now, as you can see, John Citizen is a fairly conservative trader with a fairly market-based portfolio. 4 big banks, Telstra, Woolworths, and a couple of others. And this is not an uncommon looking portfolio in current market conditions. And the total market value of the account at the moment is displayed here. Now, Julie was talking about the gearing ratio, and that's the way it'll be displayed on your page at the top here for easy tracking purposes. And of course, all of this pricing updates in real time. So while the market is opening, you'll be getting second to second updates, not only of your market value, but that all important gearing ratio, allowing you to better manage your portfolio, the potential rewards and any risks that might be associated with it. Now, of course, as you know, Leverage don't lend 100% against any one stock. And in fact, that, of course, is market practice across the board. But as you can see, lending ratios do vary by stock to stock. And that lending ratio is listed here for existing positions. And you'll be able to find that on our platform if you're looking for individual stocks. And you can see then that 75% turns out to a lending value that's less than the market value of the stock. But it's all calculated in real time for you. It's all available individually or in total down the bottom here. So you'll always know exactly what your lending value is, that is the amount of collateral you have available for investment purposes. And you can see here the lending value is here, and the variable loan at this stage is at this level, and the difference between the lending value, that is the value of the collateral you've lodged, and the loan amount is the available funds. And that's easily displayed for you to quickly work out exactly how much you have to invest at any given time. And of course, as you transact, as you take trades and leverage them, all of that will be reflected here on this platform and updated live to give you a continuous appreciation of your exact position in the market. Now, I've had to cut this page into two for illustration purposes, but on this same page at the bottom is some very important account information. You'll see all of those key ratios that we talked about in one spot, and moving further down, you'll see further collateral. It's not just shares that can be used in this investment environment to secure your leverage. You can use managed funds as well, whether they're bought on M funds or not. And so there are more options for you, or more choices for you. Let's leave the word options out of it. There are more choices for you as to how and what you leverage in your portfolio. Now, you'll note that at the top of the page and in this summary section, we saw an available funds amount. Now, that is if you were to just invest straight cash. But of course, if you are to leverage, in keeping with the rest of your portfolio, you may want to know exactly how much that means you can buy at different leverage levels. And that's calculated for you at the bottom of the page. So while you have, you could invest 100% of that 104,000 into any security. If you want to continue with the power of leverage that's been introduced in this portfolio, you can quickly see exactly how much more you can invest if you wish to. So all of those calculations, all of that information, all on one page, not here in this presentation, but on your platform, and you'll easily be able to see what's available and what you what you need to do to increase your exposures over time. Now, one of the key aspects of looking at leveraging is understanding how to compare our different investment strategies. Now, Julie showed you a table earlier that showed the power of leverage, how over time, where returns are positive, leverage increases, it magnifies those returns. Now, it was also true on the negative side. If markets fall and returns are negative, leverage also magnifies those potential losses, and that's an important part of the risk aspect. We are increasing the risk aspect of the portfolio overall, but there's a very good reason for it. We're looking to increase rewards, and as Julie pointed out, not for their own sake, but in keeping with your own investment goals. So in looking at that sort of comparison, we can't just look at market performance. We have to look at what that means in the hands of an investor. And in making these calculations, comparing leveraged investments to unleveraged investments, it's important we look at the total return. Now, calculating total return is just a matter of arithmetic. It's not that big a deal. However, it does have a few details to it. We have to make sure that we capture all of the income aspects and deduct all of the expenses involved in investment before we look at the total return. Once we've calculated all of the income less all of the expenses, we compare it to the capital that we use to generate that return, and then look at the percentage return on capital employed. And that then gives us a fair comparison to look at leveraged and unleveraged investments side by side. Now, it's important to note in thinking about all of the income and all of the expenses that we look at things like capital gains, we look at dividends, we look at franking, interest payments, we look at the tax deductions that are associated with a number of the expenses involved in the investment, and we look at the tax liabilities that arise from successful investment or otherwise, and include all of those in our calculation of the return on the investment. Now, we'll look at a couple of real-life examples later on, but the principle here is the important one. We've got to remember to capture all aspects of our investments if we want to make fair comparisons between them. So I'm going to hand back over to Julie now, and she's going to give you a breakdown on how a particular total return calculation might look.
Sure, thanks, Michael. So I'm not going to go through all of the numbers in particular detail. And again, look, I've just made assumptions here. So for example, we're assuming that the marginal tax rate is 39% in this case, which includes the McKay levy. So in this case, I'm also assuming constant capital growth of 6%, dividend of 4.3 per annum, which will be 62% franked. And I'm also assuming that dividends are reinvested. And again, I'm going to come back to that point about reinvesting dividends when we look at the risk management strategies. And so look, the important point here is to say, all right, so you're paying, for example, 6.5% per annum, say loan interest, which looks like, you know, in this particular case, because we're looking at a 100,000 portfolio, which somebody has borrowed 50,000, have got 50,000 of their own, which would look like about 3,250 of interest. But in fact, actually, you know, that sort of headline number, you go, oh, actually, that's quite large. But in this particular strategy under this portfolio, in fact, the client is pretty much cash flow positive when you look at dividends and franking credits on an after-tax basis. So again, that total return approach, after tax, after fees, et cetera, et cetera. This particular scenario didn't include brokerage fees simply because trying to sort of say when people did and didn't trade gets a little bit complicated. So I have simplified that in some respects. But it's the next slide that I want to show you, which is this comparison between geared and ungeared, okay? Now, first of all, I want to make it very clear in this scenario, the ungeared, so the person who didn't borrow, you have to make sure you're comparing the correct investment amount. So we're saying that the person had 50,000 of their own money, and if you were the geared investor, then you borrowed another 50,000. But as a geared investor, you're also forking out potentially some money for interest and all this sort of stuff. So what I've done in this particular scenario, I said, well, look, if there's any extra money going out of your pocket as a borrower, then the non-geared investor also invests that amount. So I'm really just making sure that this is absolutely apples to apples in a comparison. And because of the way I've set up the portfolio, so I'm assuming 6% growth and dividends of 4.3% per annum, essentially you can see there that if the market only goes up by, about 1%, then the geared and the ungeared portfolio perform about the same, which is basically, they earn dividends, after tax, a bit of capital gains, all that sort of stuff, right? So they actually perform the same. So if your view, and this is getting back to deciding how much you should or shouldn't borrow, if your view is that the particular portfolio, the market as a whole, is only going to go up by about 1%, then it doesn't particularly make sense to gear. It might make sense to invest because you're still earning about 4%, but it doesn't make sense to gear, because why would you take on the extra risk when you can achieve the same return without borrowing? You simply wouldn't do it. And as Michael pointed out, that certainly, gearing does magnify the potential returns. And again, linking that back to your goals. And there is this idea of, sure, if the market goes up as expected, so we're saying 6%, per annum over 5 years, then you can see that the borrowed investor very quickly outstrips the non-geared investor. So the borrowed investor earns over 12%. The non-borrowing investor earns, just over 8% per annum, right? This is on an after-tax, taking into account all of the returns that they've earned. But clearly on the other side, you're looking at if the market were to fall by 6%, per annum every year for 5 years, then very clearly the borrowed investor suffers worse than the non-borrowing investor. What I find very interesting about this particular scenario, though, and the way I've set up this particular portfolio, is that for the borrowing investor to break even, so to earn, not be worse off or better off, just simply to break even, the market would have to fall by just over 1%. So it's actually quite a compelling case given this particular market expectations. So again, it all comes back down to this idea of, what do I think the markets are going to do? How do I think my portfolio is going to perform? You do need to think about the distinction between how much of that is going to be dividends versus how much is capital growth, because the dividends could come into the cash flow impact that you have. So this idea of dividends potentially offsetting your interest costs on an after-tax basis, okay? So in other words, becoming cash flow neutral as a part of the strategy. So it is important to think about what you think is going to be capital growth versus dividend. Equal strategy, it's perfectly fine to have a strategy, comprised only of capital growth. That's perfectly okay, but it just has slightly different break-even points, slightly different cash flow aspects here. So again, this idea of that, you just have to have the market do, in this particular scenario, for example, above 1%, and you are quickly outstripping a non-borrowed investor. But as we've said, reverse is also true. If the market does fall, then it does magnify your losses as well. I think then I was going to go on to those risk management strategies that we've been sort of talking about a little bit and hinting at here. And frankly, I say, diversify. And just in case you didn't get the message, I put a couple of extra bubbles there. So diversify. That is not to say that you wouldn't gear just against one managed fund or one particular share. If that suits your circumstances and if that suits your appetite for risk and so forth, that's perfectly fine and acceptable. But it all depends on how you manage risk. So clearly, if you're taking a concentrated portfolio, so if you are highly geared against one particular share, then the techniques you have to use for risk management have to be a lot more disciplined, okay? But if perhaps you are only doing 50% against a diversified portfolio, then you could perhaps take a little bit more a relaxed approach to your risk management. So again, diversify to me is an important component, but it all depends on your capability, your knowledge and your skills in investing. There's two bits here about this cash flow idea, which is to pay your interest and to reinvest your dividend. And again, this is simply just all about your target gearing ratio. It's this idea of not letting your gearing ratio drift outside of your goal or your target. Because remember what happens if you let interest capitalize to the loan. So essentially, we saw, for example, in that dashboard that Michael put up that you had certain borrowing capacity, you certainly use that to pay your interest, which in effect increases your loan amount, which obviously has the impact of increasing your gearing ratio. Again, perfectly fine, but is that in line with your strategy? So again, this idea of dividends, you just don't let returns leak out of the strategy. You capture it so that you've got that total return aspect and the monitor and act idea. So what I'm talking about here is this idea of prudent investors who understand the markets that they're working on, understand their risk appetite. Certainly nobody should ever borrow more than they could afford in repayments. But when you're looking at a margin loan, again, unlike a home loan, it doesn't have a principal repayment component. It's an interest-only loan. So you only ever repay principal when you sell your portfolio, or you decide you want to reduce your gearing ratio, whatever it is. So this idea about borrowing no more than you can afford in repayment comes down to this idea again of expected dividends relative to the interest you pay. So again, if you choose a portfolio that has only capital growth components in it and very low dividends, low to zero, then you have to be able to make sure that you can afford the interest on the amount that you choose to borrow. So it really does come down to working out what you think the dividends are relative to, the interest that you're going to pay. There is also this idea, and we've talked about this briefly before, about maintaining an appropriate gap, appropriate in the sense of your circumstances and market expectations. So maintain an appropriate gap between the gearing ratio and the LVR. And this idea of what we call a buffer, this is the first time we've introduced this idea. This idea of the buffer, what we do is we've said that the bank will lend up to a certain amount for a particular stock. We use an example of BHP to 75%, and as you saw on that dashboard, sometimes it could be more than that, maybe 80, sometimes it can be less. For some IPOs, for example, we might only lend 60%. So there's a whole variety depending on the shares and equities and managed funds that you use. But we don't trigger a margin call every time your gearing ratio exceeds the maximum amount that we will lend. We only trigger it if it exceeds it by the maximum amount plus a bit of a buffer, because markets move around, it goes up a bit, goes down, every second of every day it's moving around a bit. So it would be pointless to trigger it every time if it exceeds the maximum amount. So we have this idea of a buffer, and Leveraged have a 10% buffer. So there's quite a sort of wide room there for the market to move out if you choose to borrow up to the maximum amount. So again, it's about deciding on the gap. So it's about understanding your portfolio. What is the maximum amount that you can borrow against that portfolio? I've used an example of 75%. And determining what sort of gap that is comfortable for you given your circumstances, the way you manage your portfolio. And just to put it in context, and I get a lot of people, there'd been a lot of scaremongering in the market and the medias about margin calls during the global financial crisis and all this sort of stuff. And certainly there were a lot of people who did get a margin call during that time. The number of margin calls increased. But when you look at the types of people who were getting margin calls, they were either in highly geared positions over concentrated portfolios. And again, that's a perfectly acceptable strategy, but you just have to understand what the risks you're managing to. So just to put it in context, if you were borrowing, say, 50% against a portfolio that had an LVR, maximum lending value of 75%, so you had blue chip stocks like BHP and CBA and whatever else, similar to what we saw on the dashboard before, then you're talking about a portfolio fall of 40% before a margin call would be triggered. Those are the sorts of falls that you saw in the GFC and the Black October sort of events. But the really important point to make here is that, the global financial crisis, that 53% drop from peak to trough, occurred over quite a few months. You had time to work out what you were going to do. The timeframes for Black October were a lot shorter, but you still had time. You could still take action as you saw the market adjust, if you saw these sort of crises unfold. So those are events that can happen. Clearly they have happened, Black October and GFC, but they're not the sort of events that occur every day of the week. Okay? So again, it's this idea around how much of a buffer or how much of a gap do you leave between your gearing ratio and your LVR. If you've only got a very small gap, so if you borrow up to the maximum, which is perfectly fine, then you may have to take more stringent risk management techniques. You may have to, for example, monitor your portfolio every day if that's the strategy you're taking. If, however, if you're taking a more conservative approach where your gearing ratio is only 50% in this example, well, then perhaps you don't need to monitor it every day, once a month, depending again on your preferences, your circumstances, and your goals. So there's this idea, again, we've talked about the target gearing ratio. And I'm not going to go in detail in this particular chart, but there's this idea of your gearing ratio changes as the market moves up. And this was simply the Street Tax 200 during the GFC. And this idea of as the market goes up, you potentially, again, depending on your strategy, potentially borrow more into that rising market to keep your target gearing ratio at 50% in this example. So this was this idea of this, as my portfolio hit certain targets, like so if the gearing ratio got up to 60%, I sold out some, reduced my loan. If it went as low as 40% as the market rose, then potentially I borrowed more and bought more into that rising market. And in this particular scenario, what you can see occurring during that GFC, even though the market falls, and nobody enjoys the market falling. That's not what we aim for, but this is about risk management, so we have to consider these sorts of circumstances. But in those sorts of circumstances, you had time to adjust your portfolio, get out of the market in an orderly manner, as opposed to taking a panic rush, and potentially getting margin call. So in this particular case, the portfolio got out, wasn't margin called, it was managed according to your strategy, circumstances, and preferences. So I think that the big trick for a lot of people, and being experienced investors, you'd be well aware of this, but I'm just going to remind everybody again that I see it so often, which is this loss aversion trap. And when you think about people taking risk, there's this idea of people avoiding risk in pursuit of profit. So that's the idea of the bird in the hand, two in the bush. And, we see it quite regularly. People come in, I want to earn, I want to have a really comfortable retirement and have lots of money, but I want to put all my money in term deposits. Well, clearly that doesn't work. It ain't going to happen, right? If those are your goals, you're not going to achieve them by putting money into a term deposit. You have to take some risk to pursue your profit, but people's nature is to be risk adverse. But a funny thing happens when you look at losses. People's nature actually becomes to take a risk to avoid a loss. So think of the circumstance where, you got a choice. You can either lose $100 for certain, or you can flip a coin and lose $20, or if it's heads and, $200 if it's tail. A lot of people would flip the coin. This is why people often, by their nature, hold on to losing investments longer than they possibly should. And this again is this idea of, as you think about, in this particular circumstances, the market falling, for example, you have to be aware of the sort of innate behavioural bias to possibly want to hang on and wait for it to bounce. But you've got to maintain discipline when we're talking about gearing. And it all comes back to your target gearing ratio, your market expectations, etc. And you've got to react to those sorts of things. So there's this idea of monitoring and acting appropriately in line with your strategy. If you've got a high-risk strategy, that's fine, but it may mean you need to monitor more, which means you need more of the tools that the CMC platform give you. But if you've got a more conservative strategy, perhaps you can monitor every month or whatever it looks like. Either way, you have to do something about it. On that note, I'm going to hand back to Michael for the next part of the risk management strategies.
Thanks, Julie. And this part of Julie's presentation fascinates me. This idea of loss aversion was first identified as part of a newer area of economic study called behavioural finance. When I say newer, it was started in the 80s by a couple of psychologists who both went on to win Nobel Prizes for economics in their work in this area. But it's very important because classic economics assumes that we're all what they call rational agents who maximise our utility. And the reality is that the existence or the experience of being a human being is very different to that of being a computer, and that we don't make our financial decisions always rationally. And another example of that is the way we treat losses. As Julie's pointed out, there is a loss aversion trap, and yet the principles of successful investing are very straightforward. We stick with winners and get out of losers. And if we can do that, over the long term, we'll make good returns as investors. The problem is, because of our human nature, we tend to go the other way. We give our losing investments too much time, and we tend to jump on our profits far too quickly. Now, one of the tools that's available to you to help deal with this very human flaw when it comes to investing is a stop-loss order. Now, you might be aware that CMC has recently upgraded our platform to include a variety of stop-loss orders, and that's part of our commitment to giving investors the tools they need to manage their loss. But the idea behind a stop-loss order is that none of us are 100% accurate in identifying good investments. And that's no surprise. In identifying good investments, we're talking about predicting the future, and none of us can do that with certainty. All of us make investment decisions that turn out in time to be wrong. And it's not, the problem with investing is not that we make wrong decisions, it's how we handle investments that have gone wrong. That is one of the key determinants of our success as an investor or not. So having a price in mind, when we enter a trade, when we decide on an investment, having a price in mind where we will say, I have this one wrong, the market is telling me, the price action is telling me that this investment is not doing what I expected, it's time to get out, is a very powerful long-term tool towards investment success. Now, the good news is you don't have to draw a line in the sand if that doesn't suit your investment style. You can use stop-loss orders in all sorts of different ways. And if you pull up a stop-loss ticket if you pull up an order ticket to buy or sell, you'll note on our platform that there is the ability at the bottom of that ticket to add a stop-loss order at the time you enter your investment. Now, that's something that I try to do with every investment I make. I set that line. Now, I can later on move it up if the investment turns out to be successful, but I make it a personal investment rule never to move my stop loss away from the market. I've done it myself, and as a manager of traders, I've seen them do it, and I can tell you that the old saying that the first cut is the cheapest is very true in markets. So stick to your stop loss orders once you've identified that price point where the market tells you you've got this one wrong, or where the market tells me I've got this one wrong. So in using stop loss orders, we have choices. And first of all, we have to tell the platform what to do when a trigger price is set. In setting a stop loss, we've determined our level, we put in the trigger price, then we have to tell the platform if we're going to then operate the order at market. Now, this is the safest way to make sure that we cut a losing position, but it can mean, for example, where a stock gaps at the open, that we might be looking at a much larger loss than we were originally thinking about when we set our stop loss level, our trigger price level. So some people prefer to use a limit price. And so if we set a stop, if a stock is trading at $11 and we've set a limit of $10 as a trigger price for a stop loss order, we might then put a limit price on that stop loss order at $9.80. And that means if the stock trades at $10, immediately the platform will sell out the position at the current market price down to $9.80. But if the stock closed at $11, made an announcement overnight and opened at $9, that's below the limit price we've set on the stop loss order, you would then see an alert generated and make a decision about how you handle that new situation. Personally, I tend to use at-market orders. My experience is when stocks gap lower, there's usually a good reason for it. It doesn't happen in 100% of the cases, and I still need to be out of that losing investment. Now, there's also a more sophisticated form of stop-loss order that allows you to lock in profits as your investments improve. And this is known as a trailing stop-loss order. Now, there's more information about trailing stop-loss orders on our platform, and you can watch some videos showing you exactly how they're used. But the principle is straightforward. The trailing stop-loss does exactly that. It trails your investment. As the share price goes higher, the stop-loss order moves higher with it. We define a trailing stop-loss order as a number of cents per share away from the current market price. So in the case of an ANZ purchase, we might say at 50 cents per share lower, I will stop out. As ANZ share price rise, that stop-loss order tracks higher with the ANZ share price, always staying 50 cents away from the highest price. However, if the market turns and ANZ share price starts to fall, the stop-loss order doesn't move. And in this way, a trailing stop-loss order will move up with your successful investments while still maintaining the discipline of a stop-loss order should the market turn quickly and fall against you. So two key components to setting stop-loss orders. One is the trigger price, the price at which I accept that I have this investment wrong, and then the instructions to the platform, how to then treat the subsequent stop loss order, whether it should be at limit, at market, or whether it should be a trailing stop loss. Stop loss orders are amongst the most powerful risk management tools available and also amongst the simplest. So there's no reason for any investor to ignore the existence of stop loss orders. I also like to set alerts on the platform. My browser alerts are free, so if I'm logged into the platform and I've set an alert on any stock based on a price, trading a share trading above or below a particular price, I will receive an alert in my browser while I'm looking at the platform, drawing my attention to that situation. If I know I'm going to be away from the market for a while, I can also choose preferences to receive alerts via email and SMS. There is a cost involved in these depending on your account status, and if you're not sure what that should be, you can look it up on your platform or get in touch with a member of our team. But be aware, browser alerts are free. If you're going to be away from your browser and need an email or SMS alert, you can set those, but there is a small cost involved. The importance, though, of the alert is very real, and particularly when we think about what Julie was saying earlier about high levels of gearing and the requirement to monitor those high levels of gearing just about continuously. Alerts are a powerful tool to help you stay on top of price moves that might be working for you or working against you, but will help you with that close monitoring of your portfolio. I'm now going to move on to some more advanced leveraging strategies using some of the investment strategies around options. I'm only going to look at two of these, but I think they'll give you some idea of how more advanced investment strategies and leveraging can work hand in hand. And in fact, there are sometimes advantages in combining these tools. And so on this slide, what I'm looking at is the purchase of ANZ, or possibly already holding ANZ, and then buying a put option, the right to sell ANZ. Now, the put option has an expiry date and it has what's known as a strike price, and that is the right at which the buyer of the put option has the right to sell. Now, on the screen in front of you, I've assumed that we have bought a put option with a $29 strike price. That is the right to sell ANZ shares at $29. And the beauty of having bought that option and paid the premium for it is that up until the expiry of that option, and it might be 1 month, 3 months, or 6 months, whatever we chose, clearly the premium is going to reflect that length of time, that amount of protection we've bought. But having bought that protection, no matter what happens, while that option is still alive, I can sell ANZ shares at $29 anytime I'd like to. And that means my downside is limited. So you can see the red section of this graph on the bottom left there is the ANZ share price as it falls, but my position is in green. And as ANZ shares fall away from $29, my position doesn't change in value. And that's the importance, and that's the reason why so many people use put options to protect their investments. Now, that sleep at night factor is important, but there's an aspect to this that's very important with leverage. That is because leverage know that you can, the company leveraged know that you can sell ANZ shares at $29 any time up until the expiry of the option you're holding. Leveraged will lend you $29 per share. In other words, if you want to leverage even more aggressively than the LVR, one way to do that is to buy a put option at the level you would like to borrow to. Now, the economics of this are very clear. Where you have that right to sell without obligation, leveraged have great comfort that you'll be able to deliver on that loan that they've made to you, and therefore the normal LVRs don't apply. But it's not just aggressive investors who use this strategy. And even if you don't want to increase the amount of leverage available to you, borrowing up to the put option level gives a lot of investors comfort that all of their potential liabilities and risks are covered. If the market falls, they can sell their shares, in this case at $29, and repay the loan of $29 per share without any discomfort whatsoever. So a powerful tool. Of course, you pay a premium to buy that option. There's nothing is free in markets, and risk and reward are directly linked. So you do pay a premium to buy that option, but many investors like this strategy because of that certainty that should things go horribly wrong, They know where their point is, and they won't be exposed any further than they know.
And then also what we find, people in the geared market who use these sort of put protection strategies to increase the amount they can borrow, they often do it very opportunistically. So they've got some view, for example, that ANZ might be sort of going to announce something in this particular example. But what they can also use it for is to diversify out into another stock or something else. So they might, for example, hold a long-term position in ANZ. Perhaps they got it as part of their employee share program, and they don't, it's a long-term hold. They don't want to sell out of it, but they want to use it as collateral to invest in, some other, perhaps an IPO or some sort of speculative. You think a mining stock is going to make a big announcement about a big fight, some sort of newsworthy thing in terms of that short term while the put option is in place. You want to be invested in something else. And we find that a lot of people who do use these strategies, it is absolutely about protection. It is potentially, when you're looking at gearing, increasing the amount you borrow. And the reason you might do that is not simply to buy more ANZ, but actually to look at opportunistic investment in other shares or managed funds or whatever else that you're looking for those, you think a piece of news is going to come out and you want to get in there, but you don't want to have to sell any of your other holdings. You want to maintain where you are, but you want to be able to take advantage of those opportunities and do it quickly. And these are really powerful strategies to do that.
Absolutely. And you might notice, as part of this strategy, we talked about the cost of buying that protection. In the options market, you don't have to be the buyer. You can also be the seller. And this leads to another very popular investment strategy. Now, this is called the buy right or the covered right. And the idea is that you become the insurance company. You're going to sell somebody a contract and receive the premium for doing so. And the rationale behind this strategy is that it generates additional income from a portfolio of shares. Now, for both of these strategies, you may be aware, if you've looked at options before, that you need to qualify yourself as demonstrate your experience in the market, and you can be qualified at level 1, and more advanced investors qualified at level 2. Both of the strategies we're looking at today require only level 1 accreditation. Now, the idea here, of course, as we discussed, is to be the seller of a call option, the right to buy. Now, what this means is if you sell a call option above current market and your shares rise, the person who bought that call option from you may exercise it. That is, they'll buy your shares at the pre-agreed price. For most investors, this is not a big deal because they're selling call options at prices higher than today's share price. And they're happy to realise their profits should the share price rise and the buyer of the call option decide to exercise. But you can see that that has an impact on overall returns. And the disadvantage to the buy writer or covered writer of call options is when share prices rise very rapidly. And you can see that from the payoff diagram here. In this example, we're looking at being a buyer or holder of BHP. And to increase returns on our BHP holdings, we sell a call option with a strike price of $32. Now, on the chart, the green line indicates my position. You can see that it rises with BHP's share price rising up to the $32 point, where it doesn't gain any further. And that's because at that level, we assume the buyer of the call option will exercise their right to buy and take our shares off our hands at $32. Of course, the payoff for giving away some of that upside in BHP shares is the premium we receive on day one. Now, you might be, if you have a legal background, it might have occurred to you that the buyer of a call option has some rights over our shares. Does that mean that we can also use them as collateral to borrow? Well, the answer to that is yes. Some years ago, Leveraged, working with other industry participants and the Australian Stock Exchange, allowed a shift, Australian Securities Exchange, I should say. I'm sorry, giving away my age here. Leveraged and the exchange worked together to come up with a legal workaround that allows you to leverage your BHP shares and also write call options against them. Now, you don't get the changes in LVR we saw with the bought put option scenario, but nonetheless, this is an important advance. In other words, you can use leverage investments and increase the income associated with those investments by writing call options against them. And Julie, how does this leveraging work in a situation where you've written a call against them?
I knew you were going to ask me that right at the very end when we thought we were going to. I think a couple of questions have come up too on the way.
Right.
Look, I'm not going to go through all of the detail because it's quite technical, and given the time we have left, I perhaps won't do that. But I think the important point here is, first of all, you can actually combine these two strategies of, buying the put option and writing the call option in very powerful ways. I think also it becomes very important, particularly if you are writing a call option, to monitor your gearing ratios, because as that call option expires, it will change the sort of amount that you might be able to borrow. So you really have to be prepared, particularly if you are borrowing up to the maximum amount allowed, that if these call and put options do change your gearing ratios and the LVR, the amount you're able to borrow, then it could become you could get yourself into a bit of a pickle. And that's why those dashboards that CMC provide with all of those data are so important. So you'll see it actually adjust with the different option positions you have there. And then as those options expire, it will go back to the more standard look, being 75 or 80%, depending on what your portfolio is and so forth. So, those dashboards are absolutely critical to successfully implementing these sorts of advanced leveraging approaches.
Terrific. All right, well, we've just got a few minutes left now. I'd like to deal with some of the questions that have arisen over the session as we talked about gearing for success, the power of two independents coming together to provide one offering. We have a couple of questions about risk management strategies and also options and leverage. I'm going to start with a couple of admin ones. First of all, we have somebody asking how long the seminar has been running. We started bang on 12:30, so we've been going for about 55 minutes here. But I have another question here. Can I leverage against any stock listed on the ASX? I'm going to ask Julie to deal with that one.
When you look at what we call our list of acceptable securities, so the things we will lend against, it runs, I think it's probably up to about 8 pages now. I think just about every stock on the Australian Securities Exchange is there. There are occasions where there's a new IPO, for example, where perhaps we don't have a LVR against a particular IPO. Usually that comes down to if customers want us to lend against it, we'll certainly look at it and determine how much we might be prepared to borrow. So I think with very, very, very few exceptions, the answer to that would be yes, we lend against all of the stuff on the Australian Securities Exchange. And I think also the list of managed funds that we lend against just keeps getting longer and longer and longer. Every time I look at the list, I still can't count them all. I think there's over 400 or 500 now. Also things like ETFs, which I think are very important sort of strategies for depending on what people are doing in their portfolios. I think that's very useful. And we've talked about the exchange traded options already, those buying puts and selling calls. So actually the range of things that we'll lend against is ending up to be almost a book of things that we will lend against.
Right, so just about anything investment grade,
yeah.
Leverage will lend against, and that's good news for those of us who like to get out into the more interesting areas of the market. What are leverage interest rates for margin lending?
So, we look at about, I think I put in my example there, about 6.5. I think we've come down again after the RBA adjusted last month. They didn't adjust this month. Certainly, when our customers, coming through CMC, they can use their relationships and whatever to negotiate some good rates with us. So, they are about, 6% at the moment, I think. I think what's also quite nice about this time of year, again, going with that total return approach, is a lot of people consider looking at it, fixing their rate for 1 year and paying that interest, 1 year of interest in advance. They can be very competitive rates, particularly at the moment, and there's potentially some very nice tax advantages for people in the current financial year, so they can actually potentially deduct the full amount of interest, a whole year's worth of interest in the current financial year. So there are some very competitive rates out there, particularly for our customers using CMC.
Terrific. A couple more questions. Another more admin one. When will there be another webinar? There might not be, but the good news is we've recorded this webinar and it appears to have been successful, and it should be posted to both the Leveraged and CMC websites in the next day or two. So if there are any things you'd like to watch again, please jump in there. I've got another question here. Somebody's asking, I have a margin loan tab, but I can't see the details. Now, where we know that CMC customer is a leverage customer, we'll link the accounts. And it's the same at leverage. Where they know that it's a CMC customer, they'll link it. But of course, it's quite possible you have accounts with both of us and neither of us are aware of that. So if you do have a look at that tab on the CMC platform that says margin loans and there are no details there, just give either leveraged or CMC a call and let the team know, and we'll make sure those accounts are linked for you. I've got another question here. Before we do that, I think we've had a celebrity come into our questioning. Julie, would you like to look at that one?
Oh, sorry, I'm going to need my glasses if we're going to start reading the small print. Okay, prepaid rates. Okay, so he's sort of saying that he's reminding me, our celebrity person, Daryl, is reminding me that our prepaid rate, so this is this idea of fixing your loan for 1 year and prepaying that interest, that year's worth of interest up front. And you might think that, oh, that's a lot of money going out the door up front, but actually it can make sense from a tax perspective because usually for a lot of people that is tax deductible. So that full year's worth of interest is tax deductible in the current financial year if you do all of this before 30 June. And actually our fixed rates at the moment for new business coming in for our CMC partners are 5.6%. So thanks very much for that, Daryl, our little celebrity on the line there. I think there was another question also about what's the minimum collateral required for a margin loan. And I think that, again, this comes down to this loan to value ratio. So, you can start a margin loan with as little as borrowing as little as $20,000, right? You can do a really small one. We've got some really nice features for those people maybe just starting out and they just want to build up. So you could do this sort of regular installment stuff. I mean, probably for these audience, they probably are more sophisticated than that and, have their own strategies about what they want to invest. But there are all sort of tools to do that. But really it comes down to what are you investing in? So look at the LVRs, look at the lending ratio. So as I used as an example, BHP, we lend about 75% of the value of BHP. A lot of those blue chip shares are often is 75. Some IPOs, we tend to maybe only lend 50%. So, it could depend on the nature of it. Managed funds could run 60, 70, 75%, again, variations there. So, there is quite a wide variety. So it really does depend on what you are investing in. And as I said, you can start with as little as 20,000 borrowing or, for those who are more sophisticated and understand what they're doing in their market, certainly, we can accommodate higher amounts than that, of course.
Terrific. Now, I have another question here. If I have stocks with another broker, can I sell a put option with a CMC options account? Well, that's not a strategy we looked at today, and it's a more sophisticated strategy. The answer, though, is yes, assuming two things. First of all, that you are qualified at level 2 as an investor who uses options. This is a more sophisticated strategy. It has a different risk profile. It's very important that if you're going to employ that strategy, you understand what selling puts is all about. And secondly, naturally, you'll have to collateralize that position. I'm not sure about this question. I'm not sure if the person is asking if they can use their stock with another broker as collateral here. The answer to that, of course, would be no. You are required to provide collateral for a sold put position to the broker where you've done the transaction. So if that hasn't answered your question, please feel free to put it another way in the questions section. We don't have a great deal of time left, so if you have any more questions, please put them through right now. We've got one here for Julie. Can I margin my portfolio or does it have to be done at an individual stock level?
Not sure I 100% understand the question. So when you look at the amount you can borrow against a portfolio, and we saw in that dashboard that Michael showed on the screen there, we saw that they each had different LVRs. One had 80, one had 60, one had 50, and so, you don't look at each individual. You look then at the total amount you might be able to borrow against that entire portfolio. So it's this idea of looking at each one and then adding it up and coming up with that total amount. So it may be that, you have a portfolio that's made up of, an IPO that has 50% LVR and some blue chips that have 75%, which gives you a lending ratio of, just plucking a number of overall 60%. And so that's what it starts to look like. So it is done on an individual level. The amount I will lend against is done on an individual security level. But when we look at the amount you can borrow, it's just done across the entire portfolio. So I don't individualize the loan against a particular share. It's just a total amount that you can borrow against that portfolio, given all of the different LVRs for those particular shares and securities.
Thanks, Julie. I'm going to make this the last question for today's session. The question has been asked, can I sell call options to generate income against all my holdings? Well, unfortunately, the answer to that is no. While leverage will offer you the ability to employ gearing in up to 500 shares, the reality of the option and ETFs and managed funds, the reality of the options market is there really only about 70 blue chip stocks over which there are options. So those option strategies we looked at, while you can certainly employ leverage where options are available, because leverage is available, it doesn't mean that options are. So just be aware of that. You can check with our team here or on the ASX's website as to whether or not a stock is an option stock. It's probably not a bad idea to have a chat with our options experts if you're considering these sorts of strategies, because some option stocks are more liquid than others, and they might be able to give a view on how liquid the market is that might help you in deciding whether or not it's the right strategy. Well, thank you. I'm sorry we've run a little over time today. Thank you, Julie.
Thank you, Michael. Appreciate it.
And thank you all for attending. As I say, this seminar will be recorded and should be available on both Leveraged and CMC websites very soon. Thanks and have a good day.